Welcome to the podcast series Decoding Sustainable Finance, developed and presented by the Nova Center on Business, Human Rights and the Environment.
Sustainable finance, very broadly speaking, is a concept used to refer to taking environmental, social, and governance considerations into account when making investment decisions in the financial sector, by pushing for more sustainable economic activities, projects, and practices. My name is Dussu Djabula, Research Associate at the Nova Center on Business, Human Rights and the Environment, and with my colleague João Botelho, Research Assistant at the Center. On today's episodes, we will focus on finance, investing, and sustainable development. Various entities, including countries, corporations, and civil organizations, have begun embracing sustainable practices across different areas, ranging from recycling and renewable energy to sustainable fisheries and organic foods. This shift towards sustainable development reflects a growing awareness of the need to reduce humanity's impact on the environment. As such, many stakeholders, from climate scientists to businesses, consumers, and even politicians, are increasingly interested in finding ways to mitigate the negative effects of human activities on the environment. In recent years, there has been a growing recognition of the important role that finance and investments can play in promoting sustainable development. Investors are now realizing that conscious and strategic investments can be a powerful tool to safeguard the future of billions of people. By allocating capital to companies and projects that prioritize sustainability, investors can support the transition to a more sustainable future while also generating financial returns. The intersection between finance, investing, and sustainable development has garnered significant attention in recent years. The rise of sustainable investing has led to the development of various tools and metrics to measure the social and environmental impact of the said investments. For instance, environmental, social, and governance criteria are commonly used to assess the sustainability of companies and their potential impact on the environment and society nowadays. Moreover, governments and regulatory bodies are increasingly adopting policies and incentives to encourage sustainable investments. These efforts have created a more conducive environment for sustainable investment and have helped mobilize capital towards sustainable projects.
Today, we have with us Nicoletta Centofanti, General Manager of the Luxembourg Sustainable Finance Initiative. Nicoletta is an environmental engineer and holds an executive MBA from Botelho University in Milan. She has an extensive experience in that corporate sustainable responsibility review and implementation within companies and around the globe. Nicoletta is committed to enhancing individual and corporate sustainability and enthusiastic about the impact of investing, social business, and environmental, social governance drivers. In short, anything that contributes to a better world. So, let's get started with the podcast episode with questions addressed to Nicoletta Centofanti. Nicoletta, once again, many thanks for accepting our invite to participate in this podcast series. My first question to you is, what is sustainable finance and investing, and how does it relate to green economy?
Thank you, João, for this question. Thank you for inviting me. It's a pleasure to be here with you today. So let's start by answering to your question and defining what sustainable finance is. So sustainable finance generally refers to the process of taking into due account environmental, social, and governance consideration when making investment decisions. And this leads to increased longer-term investments into sustainable economic activities and projects. More specifically, when we refer to environmental consideration, therefore the E, we may refer to climate change mitigation and adaptation measure, as well as environmental more broadly, such as the preservation of biodiversity, pollution prevention, circular economy, just to give a few examples. Same for social consideration, the S, we may refer to human rights, but also inequalities, inclusiveness, labor relations, investments in human capital and communities, and so on. Finally, the G, namely governance consideration, may refer to organization management structures, employee relations, executive remuneration, and so on and so forth. All this plays a fundamental role in ensuring the inclusion of social and environmental consideration in the decision-making process of public and private institutions. However, to better explain what is sustainable finance, I believe it's worth to mention the difference among sustainable finance and traditional finance. And to do that, I would like to briefly explain the flow of capital. I guess you know this concept. So basically in our economy, we have savers and investors that basically give their money to the financial sector. I'm making it very, very, very simple for this podcast. And the financial sector in these various institutions then use this money to finance our economy, projects and companies, right? And in traditional finance, normally traditional dimensions were considered, so risk and return. When it comes to sustainable finance, in this flow of capital, we have to consider also the ESG dimension that I briefly explained before. Then to go back to your question, in order to understand the relation between sustainable finance and the green economy, we have to first define what green economy is. So a green economy is defined as a low carbon, resource efficient, and socially inclusive economy. In a green economy, growth in employment and income are driven by public and private investments into those economic activities, infrastructure and assets, for example, that allow reduced carbon emission and pollution, enhance energy and resource efficiency, and prevent the loss of biodiversity and ecosystem services. And here I'm using as a source the UNEP. Considering what we just said about sustainable finance, green economy is thus closely related to the environmental criteria of the sustainable finance investment domain I explained before. In particular, sustainable finance is the means to support green economy. To put it in a different way, green economy is possible thanks to sustainable finance investments that are financing projects that foster a carbon neutral economy. Basically, green economy can't exist without sustainable finance investments because we need this capital to make our economy transition.
Many thanks for your answer. And this leads me to the following question. Why is sustainable finance the road to take in order to fund the just transition?
Again, I like, João, to start by the definition, right? So we are all on the same page. What does a just transition mean? A just transition seeks to ensure that the substantial benefit of a green economy transition are shared widely, while also supporting those who stand to lose economically, being they countries, region, industries, communities, workers, or consumers. And here I'm taking the EBRD as a source. Therefore, as per what we said before, sustainable finance is instrumental to fund the just transition. But for this to be effective, other activities and sectors need to collaborate too. In fact, it's a real complex pathway because to achieve and effectively fund the just transition, you need multiple players to work together. We need policymakers, financial institutions, corporate, civil society, just to name a few, and they all need to contribute to this transition. For example, it's not only the financial sector that needs to contribute. Governance and policymakers also have a key role to play at ensuring this transition is effective and reaches all the sectors and geographies. It is very relevant that policymakers support and commit to a just transition. For example, at the EU level, we see the Just Transition Mechanism, which is a tool that ensures that the transition towards a climate neutral economy would happen in a fair way. The idea is to try not to leave anyone behind, and it provides targeted support to help mobilize around 55 billion euros over the period between 2021 and 2027 in the most affected regions to alleviate the social economic impact of this transition. Therefore, going back to your question, sure, sustainable finance is a key aspect to ensure the just transition, as, for example, larger amount of capital are and will be required to achieve the current challenges and reach the sustainable development goals. Let's try to give some concrete numbers. Europe will need an estimated 350 billion as additional investment per year over this decade to meet its 2030 emission reduction target. And here we are speaking only about the energy system alone. So, generally saying, sustainable finance investments to ensure and fund the just transition have to address all the economic activities and sectors, but also all type of financial assets, projects, and as well as different type of investments and countries. So a final word I would like to say with regards to the concept of transition, here we really have to be aware that the transition of our economy's activities is, as I said at the beginning, a complex but also a long journey. And unfortunately, the shift can't take place right away, right? And that all the sectors and activities will have to transition. And those activities and sectors have also to be supported in the right way to ensure that while we transition, some sectors don't stand behind or become stranded assets. And here I really believe that innovation and technology will play a key role to foster the change we need here.
Wow. Many thanks for your answer. You've raised quite an important point that policymakers and everyone in general should have in mind when reflecting upon climate change.
And this leads to my third question now, which is, what do you think makes an investment or financially worthy of sustainable label?
Thank you, João, for this question. So let's try to answer, right? It seems an easy question, but it entails a certain complexity. Well, we saw a bit the definition of sustainable finance together before, and knowing the definition of sustainable finance, we are able to assess when talking about an investment, what type of sustainable investment we are referring to. Is it addressing the E, the S, the G? Is it addressing the three together, so to say? And which dimension is it addressing? Then, if we look at the regulation, I believe that at the EU level, the current regulatory framework is really trying to help all actors, particularly financial institutions, but then also an investor, identify sustainable investment. In fact, the pieces that are being put together are providing a classification system, a disclosure system, and hopefully very soon also a reporting system. All these addressing the ESG dimension we mentioned before. So in this way, the EU regulation is fostering disclosure, data reporting on the ESG criteria, and providing structured and standardized requirements to define an investment or financing as sustainable if we want. Then apart from the regulation, there are some other tools that can help us, so to say, classify an investment as sustainable. So, for example, sustainable finance labels. So in this case, when an investment or a financing has a specific label, we have to know the criteria behind this label, and then we would know that these criteria are applied, right? So we have to know what the label is about, its criteria that are being assessed through it, and we can be available what kind of sustainability criteria this investment or financing is targeting. However, to really make an investment or financing sustainable, this is a bit my hope. In the near future, we would need to be able also to assess the impact of those investments or financing. So whether this impact is positive or negative, and whether what type, right, or of ripple effect they are causing or enabling. So it will really be fundamental that all sustainable finance investments measure and therefore assesses what they are achieving and if this is aligned with your objective and commitment they claim to have. So the LSFI, the Luxembourg Sustainable Finance Initiative, has recently published a study in this respect. So last December, in this study that we published, we tried to measure where we stand in terms of sustainable finance investments in Luxembourg, but also we tried to describe the state of the art of the methodologies that are currently available to assess and measure the impact of investment I was talking about. And of course, I would suggest everyone listening to this podcast to have a look at our publication.
Thank you so much, Nicoletta. You have been giving us very insightful answers to very important questions. As a final question that we have for you is, from the investor's perspective, how can they identify and decide whether an investment is green? In more practical terms, of course.
Of course. Thank you very much for this very, very important question. If you don't mind, I would suggest to rephrase your question in order to refer not only to green investment, but more broadly to ESG investment. So how can we identify those investments that foster green, social, and governance criteria? There are different ways to identify this type of products. As I said, there are labels that investors can look at. For funds, it is also possible to check the fund investment policy, eventually starting by the fund name and deep diving on where they intend to invest. And also for bonds, investor could understand what type of objectives or activities are financed through this investment. Additionally, there are also platforms like the Luxembourg Green Exchange that displays only securities that are verified and that pursue sustainability objectives. Finally, when investing directly in listed assets, for example, a stock or a corporate bond, it is also possible to check the company website and understand really the value of the company, the commitments that the company has towards the way it intends to transition, and also the path they are following to achieve their sustainability objective, and especially the impact they are having with their product or services into the real economy. However, I reckon that on most occasions, maybe we don't have time or the right expertise or skills to do this research, right? Then it's possible to go to our financial advisors and, very important, ask questions. In this case, we have to know that the European Commission, again, has recently set up an important legislation. It's called MiFID II. And here, specifically, investors now have to be asked by their financial advisor about their sustainability preferences when investing. And based on their preferences, they will have to be offered of the product that matches those preferences. Of course, when mentioning all these possibilities, we are also assuming that the investors is really aware and informed about sustainable finance, and more importantly, that the investors is interested in sustainable finance investment. So in fact, we tried to assess this in Luxembourg. So the Luxembourg Sustainable Finance Initiative last year issued a survey that was conducted among different retail investors, basically citizenship of different age, gender, professionalism, and education level. And basically, we wanted to understand the willingness and interest of those people to invest into sustainable finance investments. In fact, we acknowledge that almost 70% of the respondents said that they believe that finance plays an important role in the transition of our economy. And more than 50% of the interviewed people said that they can imagine investing in sustainable finance products. However, it's important to underline that around 60% still consider profitability and risk, so the key traditional finance driver, a key investment driver. And they would like, in fact, to be more informed. If you have a look at our survey, you will see that almost 50% struggled in the definition of sustainable finance. So while giving all these examples, we are also assuming that currently the market, so the financial market, can fulfill any desire of the investors when it comes to sustainable finance preferences. However, we'll also have to take into account that when it comes to sustainability preferences, the retail offering is still being developed, and that we need new tools, new solutions to foster and enable sustainable investments. As LSFI, so as Luxembourg Sustainable Finance Initiative, we really believe that retail investors are a very, very, very important piece of the puzzle, as the change has to come from different directions. So increased demand, increased awareness from the retail investor side is the key way to foster the offer and achieve the transition we all need from the bottom.
Thank you so much, Nicoletta. That answer was wonderful. And from our side, that's exactly what we were looking for in your answers. Thank you so much.